Very good afternoon to all of you. I am CA Naveen Vadva from Taxman Publications. I lead this R&D department of Taxman. So I welcome you all in today's webinar on simplifying transfer pricing and thread of reporting. So today we have two eminent speakers, Ms. Karishma and Suchint Majumdar. So Karishma is a qualified CA, CP and lawyer. She has 25 years of experience focused on the transfer pricing with extensive experience on dispute management and resolution, including MAP and APS, global compliances, and consulting on complex transfer pricing issues. She has also featured in the list of top 10 transfer pricing advisor in India, and she was nominated amongst the tax controversy leaders and women tax leaders by International Tax Review consistently for last 5 years. So welcome, Karishma. Our next speaker is Suchint Majumdar. Suchint specializes in the areas of transfer pricing and international taxation. He is a qualified chartered accountant, CMA, CS, and alumni of IIM Bangalore. Suchint has contributed to publications such as COVID benchmarking in uncertain times and has served as the IFA country reporter on the subject future of transfer pricing. Please join me in welcoming Karishma and Suchint. So in today's webinar, you won't have any right to speak. So whatever queries you have, you can post in the chat box given on your right hand side. All your queries would be addressed by the speaker at the end of the session. So I won't take much of your time and will hand over the session to Suchint. So now over to you, Suchint.
So could I request Karishma to begin?
Hi, am I audible?
Yes, Karishma, you're audible, and okay. I'll be sharing your presentation.
Right. Yeah. So thanks, Naveenji, for the introduction, and thank you again, Taxman, for the opportunity to interact with tax professionals who are interested in the area of transfer pricing. I am actually, as Naveenji said, been focusing on transfer pricing for the last 20 years, since the time the regulations have come in to India. It's been like 2 decades now in terms of the transfer pricing regime that has been initiated in India. And this journey has been, in a way, a great learning experience for all the stakeholders involved. When I say all the stakeholders involved, I mean tax professionals like us, tax authorities. Okay, can be a bit loud. Right. So I was just saying that it's been 2 decades of transfer pricing, and this journey has been a learning experience for all stakeholders. When I say stakeholders, it is all kinds of stakeholders. It is tax professionals like us. It is the taxpayers, which are the companies, multinational companies, overseas multinational and Indian multinational companies, and the government authorities. It has been a very engaging journey the last 20 years, I would say, in terms of understanding the various nuances that get involved in transfer pricing. As we all know, transfer pricing is a subject that is connected to tax, but the importance has been overemphasized because of tax. But in a way, what I have learned as a tax professional in the last several years, I believe that transfer pricing is more a business subject than a tax subject, because it goes to the root of actually pricing your transactions in case of related party transactions. It goes into the root of understanding, what are the functions and the risks assumed by the various parties and how these parties should get compensated across jurisdictions. So any kind of compensation cannot be determined without understanding the core value chain and the core functions involved. And therefore, as I mentioned, more than tax, it's actually a business subject. That is actually what got me interested in this area and has kept me so engaged and interested in the last 20 years, because you learn various business models of companies, you understand the various value chains, and value chains and business models also are evolving. So in the erstwhile you had the brick and mortar model, and in today's world we are all moving to e-commerce and digital. So again, the way of doing business is very evolved, and therefore the whole way of pricing is also becoming very evolved. So therefore I think it's important to not overcomplicate transfer pricing, and which is why today's topic is simplifying transfer pricing. And there's no better person I could think of than Suchint, who can do justice to this in terms of the presentation, because he brings with him also similarly 20 years of experience in transfer pricing, and he's seen the length and breadth of how to handle documentation, how to handle the assessments, etc. So if I were to summarize the thread of transfer pricing, it can go into three buckets. The first part of it is related to the income tax law, which is compliance with the income tax law, the documentation aspects. The second part of transfer pricing is related to business and planning. This is also very important because, as I mentioned, that the entire pricing of a business and the value chain is interlinked. So that is the second part. And then the third part, which is like off late in the last couple of years, again, taken significant importance, is the governance aspect. Because, one aspect is about from a tax angle trying to justify, but it is equally important from a shareholder's perspective. If you look at it from the eyes of the audit committee, or if you look at it from the eyes of the board of directors, or if you look at it from the eyes of the shareholder, it's equally important to understand that within group companies, the right allocations of profit is happening, and there is no unjust or unfair allocation happening just because of there being a related party involved. So the third element is also gaining significant amount of importance in the last few years. And therefore, when we talk about transfer pricing, we often hear of terms like transfer pricing study, intercompany agreement, transfer pricing policy. Again, TP policy may be a global policy or a Companies Act governance policy. So various of these terminologies have an overlap. And I believe that Suchint is going to try and simplify understanding these aspects for us in today's session. And so with that, I would like hand over to Suchint to take us through his presentation. And then towards the end of the session, you can keep putting in your questions in the chat box, and towards the end, we will take up questions and then conclude the session. So yes, over to you, Suchint.
Thank you, Taxman, at the outset for giving us the opportunity, and thank you, Karishma, for a very generous introduction. And good afternoon, or good evening, or good morning, wherever all of you have logged in from. And thank you for joining this webinar. To set the context, what we will be doing here is in the next about an hour or a little less, we'll try and focus on three basic elements that we would want to deal with. One is to do with comparability analysis, and we will do some build up towards that comparability analysis. The second is the focus on transfer pricing policies and related documentation that arises out of either policy or contracts or transfer pricing documentation. And then we will focus on some elements of threads of reporting, as it were, which is, in other words, how does transfer pricing get linked to various forms of reporting, and how do you do some level of data extraction from different discrete sources of information. We'll skip through, or we'll go through the next few slides rather quickly, because they are to do with the concept and introduction. And by and large, with the passage of time, we are familiar with the fact that transfer pricing essentially deals with the comparison of a transaction that takes place between associated enterprises and looking at it as though the transaction had taken place with unrelated parties. And so you are in effect seeking to substitute, as it were, the transaction as if it had happened with unrelated parties and matching that or comparing it with the transaction that has taken place between related parties. And then determining whether the price charged or the terms of the transaction are consistent with those that would have taken place between unrelated parties. So, and that's where the element of either comparability analysis or the elements of a transfer pricing policy, and then leading up to how these transactions get reported comes into the picture. But at the core of it is the aspect of comparison between related and unrelated party transactions. Now, when we look at related and unrelated party transactions, we therefore need to first of all say that has there been a transaction that has taken place between related parties, one of which is a non-resident or both of which are non-residents, and also that if there is in fact a case where such a transaction has taken place which has a bearing on profit, income, loss, or assets, then there is a international transaction between associated enterprises that is said to have taken place. And as a result of that, compliance follows, which is that you either have to document that transaction, which is to say that as a result of it, demonstrate that the transaction is either conforming to arm's length, or if it is not conforming to arm's length, then how does it ensure, how do you make it conform to arm's length, which is in effect making an income adjustment or an expense adjustment. And then you have to report that transaction for compliance and disclosure purposes. So these are the two fallouts, as it were, which is the documentation and the reporting of the transaction. Now, when we speak of transactions, there are some typical transactions that are very customary associated with transfer pricing, and those are in the context of manufacturing. You would expect to see raw materials and finished goods, and therefore the conversion process between raw materials which could be purchased from an associated enterprise, sold to an associated enterprise, or finished goods which are converted as a result of manufacturing, either sold to third parties, but of the raw materials that were imported from associated enterprises, or there could be a sale of finished goods to associated enterprises. There could be distribution activity. Distribution will typically involve purchase of goods from associated enterprises and the sale to unrelated parties, and that becomes the transaction that is measured. And then there are a host of services. Services could essentially mean either you provide services to third parties, but based on services that you import, or very often services that are provided by a company to group companies or to associated enterprises outside the country in a variety of ways. And such services could be anything from strategic services to more customary business services, such as those of software development or administrative services, which are relatively less complex and of lower value. When we speak of intra-group services, and this has been again an area of focus for the revenue authorities, particularly because services as well as intangibles tend to capture the mind space for the reason that they are not, for one thing, subject to any form of customs. Although there could be GST implications, but again, it's more in relation to the importation of services. But if you think of export of services, it's quite unlike export of goods. There's no customs valuation involved in relation to services. So therefore, services and intangibles tend to lend themselves to a greater degree of profit shifting, as it were. And so typically intra-group services could include various forms of technology services. There could be services in the nature of intra-group services, such as management services, marketing services, supply chain services, and the like. And there could be some research and development services as well. And then there are capital financing transactions, which involve loans and guarantees. They could, in more advanced countries, include cash pooling. We don't have those rules, but loans and guarantees predominantly form parts of capital financing arrangements. The next point, after having dealt with transactions, is to then look at what the consequence is of an arm's length price. And as Karishma alluded to it earlier, the goal of the arm's length price is to ensure that at a very fundamental level, there is no abuse of transfer pricing, which is to say that you are not seeking to shift profits and pay lower taxes as a result. What that means is that if you are in a low tax jurisdiction, you would seek to bring more profits into that jurisdiction because it would allow you to decrease your effective tax rate of the group. On the other hand, if you are in a high tax jurisdiction, you would seek to reduce the assessable profits in that jurisdiction because you would end up paying a higher effective tax rate of the group. And at the same time, very ironically, it just so happens more or less that you find a lot more substance, in other words, significant people functions, functions that are relating to development, enhancement, maintenance of intellectual property or exploitation of such property taking place, in fact, in the high tax jurisdictions, because that's again where often the markets are. And so the curious case is that of high tax jurisdictions actually forming the base of value creation, but low tax jurisdictions being attractive from a profit shifting point of view. And therefore, there is a need to determine whether in high tax jurisdictions or low tax jurisdictions, the profit that is reported by way of these international transactions and that arises from these transactions is in fact the appropriate level of profit that is subjected to tax in those respective jurisdictions, because each country is going to, in the end, seek to determine whether the level of profit is appropriate for the functions that are performed in that jurisdiction, and at the same time seek to get from the other jurisdictions a higher share of tax if it finds that, or if it believes that the functions or the conduct of the transacting parties are not consistent with what would have taken place with unrelated parties. Going into the mechanics of determining the arm's length price, there are various steps that are to be followed. And the key to it is the understanding of the business model. And as a result of understanding by the business model, you then determine through a functional analysis as to what each of the parties is engaged in. And this reflects the function asset risk analysis. And then it leads on to characterization of the parties that are engaged in the transaction. That in turn gives rise to the most appropriate method on the basis of which the transfer price can be measured. Once you determine the measurement, the method on which you would test the transfer price, then you apply certain filters and you get into comparability analysis. And you get into comparability analysis with a view to identify the appropriate uncontrolled transactions that would be compared with the controlled transaction. And then that's how you arrive at the comparables. You of course need to arrive at the selected or tested party or tested transaction, which arises, and that's what you benchmark the comparables against. You will have the effect of the range because there is a prescribed range now. There used to be an arithmetic mean. Now that's largely replaced with the range. Then you determine the margin, and which is the tested party's margin if it is a margin-based method. And then you justify the arm's length price and or make corrections to the price, to the transfer price, and then have documentation supporting all of these steps. When we look at economic analysis, and this is what we would be focusing on, we would start with determining as to what is the understanding of the business, because you start with the understanding of the business to say that who does what in relation to the transaction, and this is referred to as delineating the transaction. And then you go into determining whether in the first place the company has certain framework around which it deals with related parties. It is relevant to note here that when we take up the determination of the entities to the transaction, we should be alive to the fact that there are, in a group companies framework, there could be service provider entities, there could be distributor entities, there could be manufacturing entities, there could be intangible creation entities, and there could be an entrepreneur. And one or more of these could be an entrepreneur. And by an entrepreneur, we mean that that entity takes the significant risks and therefore is entitled to significant rewards or losses arising from the greater running of the business. And so it's important to keep in mind that there is the entrepreneurship where the entrepreneurship lies, because people who are not the entrepreneur can effectively be used as being the tested party, because those are simpler and less complex entities. The entrepreneurs are normally not used as tested parties because each entrepreneur will have their own strategy, and the implementation of their strategy could give very different results. And therefore, it's appropriate to look at the entity that is being tested or the transaction that is being tested as having the ability to test it against relatively non-complex transactions, and as a result, the tested party, as it were, or the tested transaction needs to be one that can be simplistically benchmarked. And when we speak of simplifying transfer pricing, one of the important elements is to make sure that you are simplifying the entity that is being taken up for testing. Of course, in cases of financial transactions, you would tend to look at the transaction itself. So the loan would be benchmarked or the guarantee would be benchmarked. And this would be done by way of a comparable uncontrolled price method typically. And therefore, in that situation, you're not testing the party, but you're testing the transaction itself. And so when you look at this, you are going to look at the function asset risk analysis in order to determine as to which is the entity that has to be tested. And then, of course, applying the method by way of eliminating differences through the comparability analysis that may exist between the tested party or the tested transaction and the comparable transactions. And on that basis, determine the arm's length price. When we look at the functional analysis, these are some key high-level steps. You need to understand the company and the market space. Now here, we have to appreciate that here we're looking at functional analysis relative to a company. If we were to look at it relative to a group, we would be doing a value chain analysis. And the value chain analysis does apply, especially if you want to determine who's creating the value in the value chain. Here, we're going one level below and we're saying we already know who are the value creators, and we are now seeking to build up a functional analysis that will help us to do comparability. Therefore, once you have determined the tested party, as it were, and the entity that is going to be the subject of the benchmarking, then you proceed to identify the intercompany transactions. You then determine as to what are the key features of those transactions on the altar of functions, assets, risks, and then identify whether there are profit drivers, whether there are value drivers that lie over and above what you have identified as part of the function asset risk profile. And then you seek to look at market factors that may affect the determination of that price on the basis of the FAR analysis. The FAR analysis is now extended to become the function asset risk market, but that's a whole different discussion. The larger point being that the FAR analysis will give us the ability to reasonably determine as to what kind of as a result of the functions, assets, and risks, and the levels of these that are assumed by the companies in question to the transaction, as to who's creating the greater value or who is in fact entitled to the larger share of the profit, or in fact, if there is a reversal, who's going to take up the losses arising from the transaction. And so the components of the function asset risk module are that you determine in respect of each of these functions who does what, and there could well be a tick and cross, as it were, or a multiple tick and box as the process, as it were, between entities when you determine who performs the functions, because in relation to R&D also you could have one entity that performs a very provides a strategic direction, but in fact the granular R&D is performed by another entity. Again, in relation to manufacturing, you could have everything ranging from a reverse, a very integrated scale model, wherein all the way from procurement to a good deal of backward integration of manufacturing, and then eventual assembly is carried out, or you could have just sub stages within that manufacturing activity, which could only be fabrication or which could only be assembly. And then there is the elements of the assumption of who's bearing the exposure to the market. And in other words, you have a product or a service that goes to the market, who's effectively carrying the risk in relation to or who's carrying the responsibility, as it were, for the quality of the service or the product. From an asset point of view, when you look at assets employed, you have tangible assets which are easily identifiable, but increasingly you would find that intangible assets are the creators of value, and services, for example, lead to the creation of intangible assets, and therefore intangible assets do take up a significant share of the construct in a functional asset risk analysis. And then when you focus on risk, you would find that there is an exposure to the market, that becomes a market risk, and who bears that? Again, it could be dependent on whether there is an entity that holds itself out to be a distributor, or whether, even if it's a low-risk distributor, does it mean that effectively the back losses get transposed, as it were, to the entrepreneurial entity, because this entity is not in effect going to the market by determining the strategy around which the goods or services are sold, but is merely orchestrating the strategy, or is only merely pulling through or being responsible for implementing the strategy. But in fact, the product positioning or the product market fit are roles and responsibilities played by the entrepreneur. So you can have various forms of combinations of function asset risk. Again, legal liability one is an important one, because you could find that an entity that is holding itself out to be the service provider is in fact backed by a larger group, and therefore the larger group might assume the service liability risk. In fact, whereas the entity that is holding itself out to the customer, or is in fact the delivery center, may not necessarily have that degree of legal liability risk. So there are nuances around that, which again, a tick cross analysis would be useful to perform. Again, the consequence of this is that where you have contract manufacturers or low-risk distributors or low-risk service providers, you would find that they tend to get entitled to lower levels of compensation. And when I say compensation, I mean not necessarily the benchmark compensation, but the profits that arise in the group then need to be allocated between the entrepreneur and the rest of the participants in the group, and the rest of the participants in the group tend to get returns that are benchmarked returns, whereas the entrepreneur tends to get the residual. Therefore, when you look at high function, high risk, you have full-fledged or licensed manufacturers or licensed distributors that assume the greater degree of risk and therefore are entitled to greater share of their residual profit, and they become quasi-entrepreneurs in their own right. When we deal with the characterization, when we finish with the functional analysis, we are able to then determine as to whether an entity is one that can be characterized as an assembler or a manufacturer or a service provider. And if it's a service provider, is it a low-risk service provider? Is it a high-risk service provider? If it's a distributor, is it a routine distributor? Is it a low-risk distributor? Again, all of this will be determined on the basis of to what extent does the entity that is the subject of the functional analysis bear the risk or determine the strategy or go to market or create value in the form of intangibles. So you could have two extremes. You could have creation of value in the marketplace, or you could have creation of value through R&D. And these are in a way two extremes. You're creating either trade intangibles or marketing intangibles. And either of those cases could result in the characterization being determined to be more in the nature of an entrepreneur and less in the nature of a routine service provider. This is important here for the reason that it could happen that we are dealing with a entity that is classed as a low-risk distributor, but in fact it is setting the marketing strategy, it is determining product market fit, it is determining how the product has to be positioned in the market, it is conceiving of the and developing the trade and distribution channels, and therefore for all practical purposes it is in fact a routine distributor. But if the contract states that it is a low-risk distributor, that could well become in contradiction to the conduct, which is that it is a routine distributor. And the guidelines of recent times, since BEPS actions have come in, have propagated the need for conduct to prevail over contract. Therefore, an appropriate characterization of the entity is relevant and necessary in this regard. Now, when we deal with the next step, which is the comparability analysis, these are the methods on which the comparability analysis would be performed. And while a discussion around the methods is in a way beyond the scope of this presentation, because the methods by themselves are almost the subject to themselves, but suffice to say that the methods are of two types. There are the price-based methods. So the comparable uncontrolled price is a price-based method. The other method is a price-based method. Then there are what are called as transaction methods. Transaction methods give rise to a price, but they start off with a margin, and they start off with a relatively high level margin. So you start at the gross margin level and you work your way up from the margin to the price. So they are one level below, and then you have the profit split method and the net margin method, which are both transactional profit methods. You start with the profit and then you get to the price by working your way up from the profit all the way through the price. So think of it as three layers. You have net margin methods that start at the bottom line. You have price-based methods that start at the top line, and then you have RPM and CPM that address the middle line. So there are these three types of methods, and then there's the any other method, which essentially is a price-based method. The goal of the methods is to arrive at the price, but how you determine the price is a function of the comparability analysis. And it is to this end that we need to be cognizant of the fact that when we apply a method, you could have a choice, as we said, between a gross margin and a net margin. But even then, you need to characterize the entity, and on the basis of that characterization, you would determine as to what method is an appropriate method relative to that characterization. So if you think of a distributor, and that distributor is, and one distributor incurs a great deal of spend towards advertising, marketing, and the channel building activities, which essentially are all activities that go to see to it that a product gets sold in the market. So you have a significantly high middle line cost, as against the distributor who incurs a very low middle line cost, but is essentially doing buying and selling with little more than an activity of buying, selling, and incurring basic selling and general expenses. Then ordinarily you can't compare the two at the net level. Or in a simpliciter construct, you can't compare the two at a net level, because the manner in which they go to the market is different. So if you think of the entity that is developing the market, that's creating the market as it were, then you would look at its gross margin, because its gross margin is intended to return enough of a profit to cover its middle line costs and return a profit. And so therefore an appropriate way would be to then apply a filter through the comparability analysis to say that I need to look at the amount of let's say a selling, general, and administrative expenses over sales as a filter to arrive at appropriate comparables in order to apply the resale price method. And in another instance, you might apply the transactional net margin method, where it concerns an entity that doesn't have significantly high costs of distribution, but even there you would have to pick up the right comparables that represent a similar intensity of function. Now that intensity of function may be interchanged between selling and promotion and channel building, but the guide is to say, are you having the same intensity of functions and comparing entities that have similar intensities in order to arrive at an appropriate comparability benchmark on the basis of which you can conclude that your transfer price is an arm's length. And so therefore in this slide, as we've seen, there are some differences in the net margins, there are differences in the gross margins, but the fact of the matter is that because of the intensity of function being different at the selling level, it wouldn't be appropriate to compare one distributor with another, because one is a routine distributor, one is a low risk distributor, and to compare the two would give us a fallacious result. So the point being therefore that when you look at methods and you look at comparables, you wouldn't go directly from applying a method to applying it on to a comparable without analyzing whether that comparable has the relevant functional analysis that is consistent with that of the comparables. We next move to the tested party, and we've spoken about this, that can the tested party be the entity that has the least complex transactions? If you're looking at a price at a transaction level, of course you are not looking at a tested party, you're looking at the transaction itself, which is, for example, a loan. But when it concerns, or a commodity, for example, these would be on the basis of prices. But when you look at profit-based methods, you're typically looking at a entity, or you're looking at a segment. And there you're going to be looking at what is less complex, in order that you can find appropriate or reasonably appropriate comparables for that particular type of transaction or that particular type of entity. And so you might find that the entity could be an Indian entity or it could be a foreign entity, and it is well within your prerogative to select a foreign associated enterprise if that is in fact the simpler entity, because it's not contingent on whether it's an Indian company or the foreign company that should be taken as the tested party. It's a matter of economic choice as to whether one represents the less complex of the two entities. When we come to the identification of comparable companies, this is a process that we go through, which is you go through a formal process of what is called an exclusive method or an inclusive method, and really you need to follow a systematic process and demonstrate that you followed a systematic process in arriving at the comparables. A systematic process therefore starts with reliable databases that already house data that pertains to typically public limited companies, and because they provide information to the registrar of companies, who in turn will provide it to the database service providers, and therefore the database providers either they have a large repository of Indian companies or they would have foreign companies, but you start with the database, and then from that you go on to quantitative, qualitative screening, and then arrive at the final set of comparable companies. It's important here to consider what kind of filters you'll apply in order to arrive at the comparables, and we've given some indicative ones. This is presumably more in the case of service companies, but you do apply these filters in some of the ones that we could talk about are the turnover filter, because you do want to make sure that the scale and size of a company is consistent with that of the tested party. While a turnover is one indication, there is also some analysis to suggest that market share could be another indication, because the size is determined, it has some degree of correlation, especially with respect to the economies of scale that are generated as a result of size. Export earning is another important criteria, because if you find that you are selling locally, then you could have very different price points as compared to what you could realize if you were to sell in the export market. A related party transaction to sales filter is important to eliminate companies that themselves are engaged in related party transactions and therefore are not appropriate comparables, because you can't compare one that's a tainted transaction with another tainted transaction. So there are some of these that apply. Negative net worth is another one, because you don't want to select typically loss-making companies, or at least consistently loss-making companies. So application of filters is an important parameter in, and you apply both qualitative and quantitative filters, but the more quantitative filters you apply, the better your comparability analysis is from an objective point of view. The next topic is that of the range, and we won't go into a lot of detail here because this is more mathematics. Earlier, it used to be the case that you would have the mean plus minus 5% and then mean plus minus 3%. Now the range is the 35th to the 65th percentile, and the range applies to all the methods except profit split or the other method. And then in addition, under three methods, which is the resale price, the cost plus, and the net margin method, you also allowed to use multiple year data up to 3 years. But the point being that the range allows you to get a more reasonable outcome than you would have under a mean construct, as we've seen over the years, and therefore there's more latitude for price setting at any point within that 35th to 65th. Now, of course, in the US, it is 25th to 75th. So most OECD countries follow an interquartile range, but this is still a better. The 35th to 65th is still better than having a central tendency based on the arithmetic mean. So this deals with some mathematical examples that you could look at separately, but they essentially deal with determining how you arrive at the median, and the median is a position of central tendency, and on that basis you arrive at the 35th and 65th percentiles. We'll now turn to the concept of policies, and this is important because of the fact that it is often considered synonymous or used as such. So you have a transfer pricing policy, or you have a TP study, and often enough one tends to think that they are much the same. The transfer pricing policy is a document that states how different entities of a group will deal with each other from a mechanism point of view. So it would say that that certain entities of our group are contract manufacturers, and they will be compensated on the basis of their total cost plus a certain profit margin. A certain entity of our group is a distributor, and therefore will be compensated on the basis of backing out from the sales price, from the end selling price, a certain margin that's appropriate for that reseller, and then sending the balance back. So that could be how you define transfer pricing policies for different group companies, by taking each of the group companies, defining what are their characteristics. So are they distributors, are they IP companies, are they entrepreneurial companies, and depending on how they are classed, their policies are set out for each such type of company. The related party transaction policy is a policy that is typically around hinged on corporate governance, and it takes up from the TP policy, but it is in some ways more oriented towards determining all forms of related parties, and these could be domestic as well as international. The idea being that the board needs to draw comfort that the parties have dealt with each other at arm's length, and therefore this RPT policy is framed around giving the board a sense of security that how is the board going to derive comfort around the fact that the transactions are at arm's length, and therefore they are supposed on or premised on a benchmarking analysis or an independent opinion about the arm's length dealing of the entities that are belonging to the group. And this is then documented and brought out in the board report. So the board would then, in fact, take not just write the RPT policy, which is to say that the transactions have to be at arm's length, but also go into defining how the RPT policy has to be actually implemented. Intercompany agreements reduce the transfer pricing policy to writing between the parties, and therefore they constitute contracts. It's important here to keep in mind that the contracts are consistent with the conduct. So if an entity holds itself out to be a contract manufacturer, then it should in fact be receiving the technology from overseas. It should in fact be selling the goods back to the principal, and that would demonstrate that, and potentially not bearing a capacity risk or bearing limited capacity risk. So those are again how you have to ensure that an intercompany agreement is the contract between the parties that brings the transfer pricing policy to life, but it also is then borne out by conduct. And then the transfer pricing study is the outcome document. It's the document that results from the implementation of the intercompany agreement and the benchmarking of that agreement and contract and arrangement with third parties to then demonstrate that the outcome is consistent or not consistent with the arm's length standard. And often it could happen that you could set up a policy that is intended to achieve an arm's length outcome, but due to circumstances beyond your control, you could end up with outcomes that are not necessarily at arm's length. But then it's important here to keep in mind that the way you set your price is the way you test your price. And therefore, if the setting of the price has been based on, let's say, a piece rate per hour with a certain budgeted profit margin, but if you haven't been able to achieve that profit margin, then build back those circumstances, claw back and determine as to what was different. And if you were to say that, but for such differences, would you have reached that outcome, then you probably would still be at arm's length. So therefore, the transfer pricing study is the outcome document. We've seen this again. We've covered this by speaking of the fact that the outcome of a transfer pricing study then follows with an accountant's report. Intercompany agreements do have the effect of having to be taken cognizance of by the board, and then they go back into the related party policy as well. and the transfer pricing policy is the larger framework document that goes into the value chain. We'll now turn to threads of reporting. We have about 3 or 4 minutes, and what we will do in this is just to give you a very brief perspective about how transfer pricing is not something that's viewed in isolation, but has a number of ripple effects in a number of other reporting forms. So whether it touches company law, or it touches FEMA, or it touches income tax, or it touches GST, all of these, especially in relation to tax, have a bearing on transfer pricing, and often enough this is useful for the purpose of how you attest a Form 3CB, which is the accountant's report. So when you look at financial statements, what do you derive from that has a bearing on transfer pricing? It's the related party disclosures. If you look at the board report, it's to do with the nature of the business is described there. The business outlook is described there. And again, there are elements such as foreign exchange outgo, and as well as the particulars in relation to the related party transactions that are disclosed in the board report. So the management discussion and analysis is an important determinant of what goes into the functional analysis of the company. The audit report may have some qualifications. Again, if they are to do with related party transactions, then they have bearing. The transfer pricing study, we've spoken of it. We've spoken of the 3CEP, which is in a way the culmination of all the related party transactions in a form, all the international transactions. The master file is to do with the group. At the group level, you assess what is the group about, how does the value chain of the group stack up, and then the master file therefore is giving you an umbrella group perspective, and that in turn then flows down into the TP studies of the respective entities. The country by country report is the statistical presentation of the master file, as it were, by giving you certain key elements of data around the different companies or the different entities that belong to the multinational group. The return of income is useful for reporting of a suo motu adjustment. So if you find that your transfer prices are inconsistent with the arm's length prices, then you may have to make an adjustment, and that is then reflected in the return of income. There's a Form A2 which is used for the purpose of exports, and this is where again you could tally this back to the transactions that have taken place with related parties. A tax audit report has disclosures in relation to related party transactions under 48(2)(b), and also captures secondary adjustment details. So again, some threads that are common between transfer prices and the tax audit report, or for that matter, the 3CB and the tax audit report. The foreign inward remittance certificate or the Form Softex are documents of export of services or export of goods, and you get a remittance certificate, which again can be tied back to each of the transactions that you have written out in the 3CB. So again, a useful attest tool for confirmation. The counterparty financials is an interesting one, because when you tend to perform an audit function, you tend to look at the financials of the Indian company that has engaged in transactions. But by looking at the counterparty financials, you're able to draw comfort that the same balances are reflected, the same transactions are reflected as are reflected in the Indian entity. So counterparty financials are a useful data point. They're also a useful data point for looking at the counterparty as the tested party. Also, sometimes in the case of cost allocations, counterparty financials can come to use. And Form 15 CSEB is a remittance document. So again, you look at this document at times to be able to correlate this back to related party transactions involving payment transactions. Two other documents, the GST return, while this is not necessarily one that discloses related party transactions, but You can get zero-rated transactions such as exports there, and you can also get the sales ledger or the purchase ledger, as it were, which again ties back, has some subsets of it relating to related party transactions. And the bill of entry, which is a customs document that is useful for correlating the import of goods for customs accessible purposes. Both GST returns and bill of entry have another effect, which is that because they are a corresponding valuation equivalent for customs or for GST, because they also require related party transactions to be at arm's length, they could serve as another counter check, as it were, although they might have potentially not necessarily exactly consistent measures, but they could serve as a correlative measure to corroborate the value of the transaction itself. So these are some threads of reporting that you could look to when you think about all of the documents that go into related party transactions. And as you see, there are a lot of ripple effects that not just culminate into the 3CB or the TP study, but a number of other documents that have a bearing on related party transactions. So with that, I think we are at the top of the hour, and I'll request Karishma to provide some closing comments, and then we can take some Q&A. Thank you very much.
Thanks, Suchin. So, Suchin, we have one question in the chat before we go to the concluding remarks. The question is whether corporate expense allocation based on actual costing can be considered as arm's length price, as no market price is available for corporate allocation to subsidiary or associate. So yeah, this is a common litigation issue that we see, corporate expense allocation, and how do you justify the ALP? So yeah, your thoughts, and then I can also add.
Sure. So I think at the core of the point is that there is a cost incurred, and the cost is incurred relative to a third party. So the genesis of the cost is the third party expense that has been incurred. Now, this expense has to be apportioned between group companies. So the key question then is that, is the allocation or the apportionment appropriate? And this goes to questions around what are the cost drivers, or where does the cost arise in order for it to be allocated appropriately? And to that extent, the totality of the cost is not in doubt, but it is the apportionment of that cost. And provided you have a reasonable basis for the allocation, which can be based on utilization of the service or utilization of the space, if it was rent, for example, which of course doesn't typically arise in a cross-functional situation, except if it was, let's say, rent in relation to server space, then it could. But if you can demonstrate that the allocation has taken place along the lines of utilization or service, or a budgeted estimation of utilization, or a cost apportionment key that represents the parameter around how the cost is absorbed, then that's what you would have to demonstrate, which is again going back to how good and how good documentation you maintain, how you get cost allocation certificates to demonstrate that you've done due diligence in order to arrive at the apportionment based on appropriate allocation keys. You're on mute, Karishma.
Okay, sorry. Yeah, okay. So yeah, I was saying that this is an issue, as you rightly said, needs to be documented well. I think the essence in demonstrating that the corporate expense allocation is at arm's length goes to three facts. One is whether a service is actually received, whether the service is needed, and third is whether there is a benefit from such allocation. And these principles have been outlaid in the OECD guidance. Obviously, from an Indian context, we don't have the requirement to prove the benefit and need test basis various jurisprudence that has played out in the last 8-10 years on this issue of corporate tax, corporate expense allocation. But I would still say that even if legally you're not required to give the benefit and need test, the way to do an ALP is what Suchint explained, is to really look at what is it that a third party would have been willing to pay for, right? And what you would be willing to pay for is, one, if you really need the service, and two is if you benefit from the service. And therefore your allocation key needs to be linked somewhere to those aspects. So for example, if you're appointing a common marketing team, then obviously in a corporate expense allocation situation, you would see that whether that marketing expense is yielding increase in revenue, and therefore revenue is a commonly used allocation key. For example, if you are using IT or HR related centralized resources and you are allocating, then you will allocate this to the parties who are absorbing this service, which are the people, the IT and the headcount, and therefore you will allocate using headcount as a key. So you will not get in a way, the question that has been put up. You will not get an arm's length price in the market, but you will definitely be able to justify an arm's length behavior in terms of what allocation should be, and that should be adequate. Is how jurisprudence has played out in the Indian context. The second question, Suchint, is can you discuss something on TP on corporate guarantee? Now, corporate guarantee by itself will be a topic in its own right. But yeah, I mean, if you want to just make one or two points, Suchint, on, this corporate guarantee has been a matter of debate.
Yeah, just to say that one is the understanding of explicit and implicit guarantees. I think that not every guarantee needs to be needs necessarily to be literally written out, but then it's important to understand what is a guarantee. It means that someone is indemnifying the ability, the possibility of a default to pay, and therefore often enough guarantees are benchmarked on the basis of the benefits that arise because of somebody standing in. Typically, it means that you get a loan at a lower rate because the group is willing to back the entity that is borrowing, and therefore that saving that arises from the interest is then split between the entity that is borrowing and the entity that is receiving the guarantee. So that is often enough a basis for determining a price for the guarantee, unless you get a comparable price benchmark.
Right. And the other issue in guarantee is implicit, explicit guarantee. If it's explicit, it's really where you really need to benchmark. Implicit is something where, again, there are contrary views. For example, giving a comfort letter, etc., considered as implicit guarantees, and the courts have held that you don't need a separate kind of a compensation for that. It's more like a shareholder activity. So again, guarantees as a subject is very fact specific. What is the documentation, etc. In terms of, so I'll take this last question, that what is the top 3 or 4 litigations on transfer pricing? Off the hand, the largest litigation on transfer pricing today is on allowance for intra-group services, in terms of the payments that are being made for management fees and intra-group services by Indian companies to overseas entities. That's the highest litigated point. The next point is the AMP issue, which is the advertising, marketing, and promotion spends. So there again, the tax authorities have taken a view that any excessive spends which are being made by the distributor in India or even the manufacturer, which may be even for its own business, is something which results into enhancement of brand for the legal owner of the brand, and therefore the brand owner should compensate something. And this issue is traveled up to the High Court. High Court has actually ruled in favor of the taxpayer to say that, first of all, such a implicit kind of an AMP activity is not a separate international transaction. And second, it can be benchmarked along with the distribution function. So this is again pending for the Supreme Court verdict. which is hopefully likely to come in this year or early next year, which will resolve a lot of matters. So the second issue is on AMP, I would say. And the third issue today, which is also yet in the rounds of litigation, is on comparables. Because while comparables as an issue may seem to be a very age-old issue, but in terms of the quantum of cases that you still see, it still kind of lingers around what is the right comparable and therefore the right range of markup. So these are the issues in terms of litigation. In terms of the new trends in litigation, we are seeing increasing use of profit split method, attribution of profits to P, royalty and intangible transactions being challenged, use of revenue split methods. So some of these are newer trends that authorities are picking up, and which is what we will see in the future in terms of transfer pricing. So with that, the other important point that I would like to mention in my concluding remarks is also the use of technology, because as we know that the GST, the entire thing has moved on to invoicing and the technology platform. Corporate tax side also, the government's focus is on digitizing everything, which is including assessments, the faceless assessments, the e-appeals, selection of cases based on risk assessment, which is the CBCR analytics in transfer pricing. And therefore, I personally feel that as a tax professional, one of the things that we need to focus on in the next decade, I would say, is using technology to our benefit to also make compliance easy. That's one aspect. Second is to analyze and gather data in terms of that's available in the group, and carry out like some kind of AI or analytics to assess risk on your own. And third is also in terms of your research and your litigation aspects, how you use technology. So I think there are a couple of these areas where we need to focus on in terms of using technology. And I would say that in the transfer pricing world, it may seem like things are being taken over by technology, TP reports, etc., being done by these so-called software tools. But that's just one small element. There are various other elements, and therefore, technology is not going to replace tax professionals, but technology with tax professionals is going to be the new era in transfer pricing. So the with technology is going to be very, very important, and as tax professionals, we cannot ignore this area. So that is the last note that I would like to leave on this session. With that, I would also like to mention that Suchin, in 1 hour, has delivered an excellent presentation. Suchin, congratulations, because the kind of the diversity of topics that you had to cover, I think it's just not possible. But you made it very simple. So thanks everybody for joining, and we will be sharing this presentation with you all after the session. And if there are any questions yet you would like us to answer, you can write to Taxman. Taxman will forward to us, and we can reply to you on a one-on-one basis. So thank you all. And with that, I will hand it over back to Naveen ji from Taxman. Over to you, Naveen ji.
Yeah, thanks, Karishma. Thanks, Suchin. Users are still posting their queries in the chat group. So, but due to the paucity of time, so we committed to complete the presentation in 1 hour. So we have already exceeded the limit. So whatever queries you have, guys, you can send it to us on our official email ID, that is sales@taxman.com, and we can connect you with the speakers on one-to-one basis. So that's all for today. So till we meet next time, goodbye. Have a safe time. Thank you.
Thank you.
Thank you very much.
Thank you. Thank you, Sachin. Thank you, Karishma.